All right. So first off, I want to make a point to mention that in Canvas there is the option for you to select if you want a grade, letter grade, or a pass fail grade. Uh, you have to go in there and manually check that for every single class. If you do not make an selection, you will be defaulted into pass fail grades. Now, again, my recommendation for that is uh, if your grade in this class will improve your GPA, take the letter grade. If it will hurt your GPA, take the pass fail. On the other hand, important thing to note is you need to check if you're transferring to another college, send an email and make sure they'll take the pass fail. Uh, I believe every college in Virginia, every public college has said they would, except for UVA. UVA is putting some more restrictions on it, but your individual situation may differ. So make sure you ask before you make your decision. Also, uh, we have the course project that's coming up and it will be due in just a couple weeks. If you would like to turn in part of it or all of it early, as in more than 3 or 4 days before it is due, I will grade it and return it to you and allow you to either accept the grade that you got or you could make changes and attempt to get a higher grade. That is up to you, but you have to have it in early. If you don't have it in early, there will be no um, fixing it later. If you wait until the day it's due and you turn it in, whatever grade you get is the grade you get. If you need help with any of those sections, you have a question, all those kinds of things, you would like some advice, please reach out. I'd be happy to help. So today we're going to go over two chapters, chapter 13 and 14. It is covering the leverage and capital structure, which we started last week. And then the next chapter is looking at dividend and dividend strategy. So your capital structure is just a fancy way of saying, how are you paying for the company? Is it being paid out of, there's three ways of paying for a company. You can borrow money, you can invest money, or you can make money. If you are in borrowing money, that means that can be getting a debt, as in you have a credit card, that can be getting a loan, or it could just be you have an agreement with a supplier that you pay them in 90 days. So you're in debt to them for that 90 days until you pay them. Investing can be everything from selling stock to selling like regular stocks, getting investors like to come on as a partner, those kinds of things. Also, um, you might see things where a company will trade future stock for funding today. So I trade, and that's a kind of a hybrid of a debt to an equity approach. You sometimes see that with what are called angel investors, where they'll go into a company and they think the company will do something great in the future. So they invest money today, but they don't get anything for that investment today. But in a year, they have the option of either taking and saying, okay, that was actually debt, you have to pay us back, or saying, no, 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 I want part of your company. And so all that is agreed upon in the when you take the money, but it's a long-term strategy for them to try to recoup some of their investment if it's a bad bet. And then on the other hand, if it turns out to be really great, then they can have a section of this company that can grow up. And then the last way is making money. If you have a company and you make profits and you take that profits and you reinvest the profits into the company, you are growing with equity, but not investment equity, but profit equity. Um, Capital restructuring, you hear this a lot in bankruptcies. Sometimes, a lot of times, it's not a pure capital restructuring. A lot of times, they're having to sell things off in order to make the money to um, get the capital restructuring. You also hear about this with small businesses. If you have somebody, and say Joe started this business 25 years ago and he's ready to retire, and it has almost no debt, he's just running it himself. It's all profit equity. He wants to sell it to someone else so they can keep the business going, but that person doesn't have the money. He wants to sell it to his right hand manager. Like, this is the guy who's running day-to-day operations now. He wants him to have the business. So what they'll do is Joe will lend the manager the money needed to buy the business. So basically taking all the equity out of the business and replacing it with debt. And then the manager will then have to pay the debt down as he moves forward with the company. That's a restructuring. It's transferring that equity into debt. Another restructuring can be your company's going through bankruptcy, so you sell off a bunch of assets, and then you get more. You use that money to pay down your debts, so then your structure is different. Now, that is not pure capital restructuring because you are using assets to do it. And the final way is you either issue a bunch of new bonds. Say you look at it and you go, oh man, interest rates have plummeted. We have great credit. We have great ratings. We can issue a lot of debt and we can go and buy another company. We can merge with another company. That's restructuring. Or you could say, man, we need money, but our interest rates are too high. Let's issue stock. That's restructuring as well. Generally speaking, capital restructuring refers to a major change, either in strategy or actual composition. So if your company right now is saying we have enough stock, we're not doing any more stock, but we are doing bonds every month, we're issuing some 10-year bonds, paying off some 10-year bonds just to keep cash flow coming in. And then suddenly you say, you know what, let's issue a bunch more stock and not do any more bonds. That's capital restructuring. The main thing is to remember that the people who are managing it, their goal is supposed to be to maximize shareholder value. That means that has two parts. One, it's obviously you make the firm worth more, but then the other thing is to lower the cost of running the firm, a cost of actually financing that firm. So for this, that is where, if you remember weighted average cost of capital, you want to minimize that weighted average cost and maximize how much value you get. Your leverage, it impacts your earnings per share and your return on equity. If you issue more debt, then you don't have to issue more shares. If you issue, or in the case of like Apple a few years ago, issue debt to buy back shares, that raises your earnings per share and raises the return on equity because you have less equity to distribute among all the money you make. That is somewhat of an accounting trick, but it is still a valuable tool that financial managers use. This is just you can see the assets don't change. Right now, the company is 100% equity, so its share price is 20, outstanding shares 400,000, 10% interest. What if they issued $4 million in debt and used that to buy back half their shares? Well, share price might not change. It might. Debt to equity ratio went from 0 to 1. But looking at this, remember, when you look at these, you need to look at 3 different models to see how much you're getting with and without debt. With no debt, your earnings per share will be fairly significant in a recession, $1.25, $2.50, $3.75. But you see, these are very narrow. there's not that much difference between the bottom and the top. There's only a 3 times difference. But look down here, if you use the debt, because remember the interest you have to pay, it costs you money. Your net income doesn't really change, but your earnings per share do radically change. It goes from 50 cents a share at the low end all the way up to 5.50, because yes, you're decreasing the amount of money you make by interest, but you're increasing, or you're also decreasing the amount of shares that you have to spread out that in earnings. It's kind of like if somebody said you have a plate of cookies and there's 20 cookies and there's 10 people. Yes, everybody gets 2 cookies. But if you were to take 5 of those cookies and throw them away, and 5 people ran after those cookies, so now you only have 5 people sharing the cookies, there's now 15 cookies, so everybody gets 3 cookies. Yes, the amount of cookies, i.e. the income, went down, but because the amount of shares went down faster or more, the amount of cookies each person gets is higher. So in this case, during a recession, being without debt is awesome. During expansion, being without debt kind of stinks. So if you look also with the return on equity, your return on equity radically increases with debt than no debt. This is something to remember. When you have no debt, you're stable. When you have a lot of debt, you're unstable. And being unstable can be a good thing. If you swing really high. Or it can be a bad thing. When you swing really low. So it all depends on what the manager values most. Is it the swings? Does he want to ride the swings up and down and all that and try to hit the highs more often and faster than he hits the lows? Or does he want to slowly grow the company's wealth year over year? So for break even, the important thing is to know how much earnings per share you have to have in order for you to be the same. Like that's what break even is. You don't want to lose money when you make these changes. So if you graph it, you can see what's the earnings per share and earnings before the EBIT, and say if your earnings per share is $2 or your EBIT was 800,000, it doesn't matter which one you did. If you did with debt or without debt, you're the same. So in this case, you would say, okay, well, if I expect your EBIT to be higher than 800,000, it would be better to have debt because my earnings per share will go up at a much faster rate. If I expect my EBIT to be less than 800,000, I don't want to have debt. So this is actually something you could look at with your company when you're doing your project. You could say, we need a capital restructure, and that be your reason. And you would just have to go through all this. So the question is, remember we were talking about how the risk and reward happens before, that the more risky something is, the more you would expect the returns to be. Therefore, you can look at the returns and gauge the risk. It's the same thing here. The more risk you expose your company to, the more likely, the worse the bad situation is, the better the good situation will be. Generally speaking, all things being equal. So this is you can go through and do your do this same kind of concept when you're creating your own portfolio at home, homemade, or for a company, if you're investing as a company in other companies, which happens a lot, you can actually adjust what that company is doing to lower the risk or raise the risk. And that's just what this is talking about here. If the value of your firm, because there's a lot of different value models, but if the value of your firm, if you think it's because of the cash flows to the firm and then the risk, then the risk to your firm's value would be a combination of the risk to the cash flows and the change of the cash flows. One of the things is you have to make, again, you make assumptions when you do any kind of modeling work like this. But when you have corporate taxes that take a certain percentage of your profits, and then you have personal taxes, or you have bankruptcy, or you have all these things, they change your model, because it's not just about how much profit you make. If you make more than a certain, if you make enough profit that half of it gets taken by taxes by the time it gets to the owners, that's not any different than if you structured it differently so that only a third of it got taken by owners, but you made less profit originally. For example, if you own a company, it might behoove you, if it's a corporation, to loan the company money and pay personal taxes only on the interest the company pays, than to pay both the interest on the company's income and then the interest on your dividends from that company. So we're getting in, there's a lot of these formulas. I'm not going to ask you to memorize these formulas or even really to know these formulas that well. Just know that they exist, and know, I'm not going to say, well, what's the exact value that this is going to change? The idea here is, do you know that what kind of actions will cause what kind of changes? Those are the questions that you'll be asked on the exam. So we can go through here. Bankruptcy costs, important to know these. The direct cost with bankruptcy, one, you have the actual cost to have a bankruptcy, but then you also have the spreading out effects. Bondholders losing money, which could cause them to have to pull out of other deals because they just don't have the money in the future. It also means that people are less likely to buy bonds if they think that bankruptcy is more likely. The indirect costs are far higher than what the actual direct costs, but you don't always see them. Like, the price of milk might go up slightly because of a bankruptcy, but you would not even be able to connect those dots because you don't realize that the company that's making the milk lost a bunch of money, or that's bottling the milk lost a bunch of money because it was invested in this company that went bankrupt. Now they have to make up some of that money so that they can stay afloat, so they have to raise prices. That kind of situation happens all the time, and we just don't know about it. And it's hard to measure, but it spreads through the economy. Because of this, a lot of times bondholders will not want a company to declare bankruptcy and will voluntarily work with a company to lower how much the company owes to keep it out of bankruptcy. Because a company that goes into bankruptcy and is completely liquidated never pays back enough money to pay everybody. So important thing to remember, your tax benefit from having interest is only important if your tax rate is high. If tax rates are low, then having interest financing is less attractive. The more you're invested, the more you're leveraged, the more likely or the worse you will hit if things fail. Okay. Okay, so this is going through some of the bankruptcy processes. It's important, just kind of important, just to be able to follow the news. You won't really be asked that much about it, but just read through these. Okay. Any questions about the stuff we just went over?
Questions?
Hmm?
No questions.
No questions. I don't know if if I go too fast, let me know. If I go too slow, let me know.
You're all good.
It's hard to remember what it was like when you learned stuff to know, oh, wait, this was a really complicated thing, or, because some of the stuff I find really interesting. And so I want to go into detail, and I have to remember, not everybody is as big of a nerd as me. All right. So dividends, actually, let's back up. Dividends are the things that a company pays its investors. It's the quote unquote paycheck you receive for investing in a company. There are two ways for you to make money owning stock. You can sell the stock for more money than you bought it for, or you can receive dividends from that stock. So cash dividend, regular cash dividends are just paid every quarter. They're normally fairly constant, set. You know what you're getting if it's a larger company. But you know what you're getting, but there's no guarantee you'll get it. So it's a big thing for when the board meets, people listen to say, what is the dividend? How many cents per share are they giving out as a dividend this time? Extra dividends are something where you have a situation that is unusual. It might be reported, but it might not, or it might be repeated. I mean, not reported, but it might not. You get a special contract. You're a ventilator manufacturer right now, and you just got a huge contract from the government for making ventilators. And so you made this extra profit. You don't have a plan for what to do with it for the company, but I'll just go ahead and distribute it as a dividend. It might not be repeated. It's extra. It's not on the regular schedule. It can be done anytime, but it's just, here's extra money. A special dividend is you cured some illness and you sold that cure to another company for a one-time payment, and you're just distributing that payment to some percentage of that payment to your shareholders, but you want them to know they will not be getting this payment again. Don't plan on getting it in the future. Don't don't invest in the stock for this payment in the future. It's just a payment one time. Here you go. So extra and special are similar, but extras can be repeated. Either it could just be you have an extra payment where you say, for the next 3 quarters, we're going to give this extra dividend because we had a better quarter, we had some big sale, but after those 3 quarters, it's going away. But it is going to be repeated those 3 quarters. Special ones, no, it's just a one time. And then the last one, a liquidating dividend, can either be really bad or it can be okay. It means that you sold either the whole company, like you might have shut down the company and sold all the assets, and the liquidating dividend is how you're wrapping it up. You paid all your debts, and now you have all this extra cash sitting there because you sold everything. You have extra cash, and so you're distributing that to all your shareholders. That's a liquidating dividend. Or you could be like Ford several years ago. Ford owned Jaguar, and they sold Jaguar, and they got a certain amount of cash for that. And so they did a liquidating dividend for Jaguar where they gave some of that cash to their shareholders. So it could be good, or it could be really bad, like the company failed. Or it could be good in the sense that, oh, they got rid of this underperforming division, and now I get extra money. The declaration date is when they actually say, hey, we're going to say this is how much dividends we're giving. Your X date or X dividend date is the last day, or there's the X dividend date is the day you have to buy the stock before to get the dividend. If I have an X date of tomorrow for Ford stock for dividends, I have to buy Ford stock today in order to get the dividend tomorrow. If I don't get the dividend, or if I don't buy the stock by then, whoever owned the stock before me gets it. The date of record is 2 days after the X date, and that's whoever is on the books that day is who gets the dividend. And then the date of payment, it just whenever, like they say checks, but nobody really does checks now. It's when the money's transferred. When you have a dividend that pays a certain amount, your stock will decrease by that amount that day. So if you see some companies that pay a whole lot of money, like there's some companies that pay 10% dividends, you'll see a major drop every dividend X date. You can even look at it, and every 3 months, they just have a major drop. And that's because you take the money, the company no longer has that money. On the X date, that money's transferred out of the company's accounts and into another account to be distributed to all the owners. So that money is no longer there for the company. Some people buy stocks before the X date so they can get that cash. Personally, I say if you're going to buy a stock, and this is my personal opinion, if you're buying a stock near the X date, wait until after the X date, because you don't have to pay taxes on that dividend. Your dividends matter if the stock is based on, if the value of the stock is based off your expected dividends. Blue chip stocks, GE, those kinds of stocks, Microsoft, where they're not growing fast. If you buy those stocks and you get a dividend, you can live off the dividend in retirement. That can be your retirement plan, is just, I'm buying a bunch of these stocks that just pay out dividends every month, every year, every quarter, and I'm just going to live off of them. It doesn't matter if your company is growing very fast. If you're buying into a company and every year it's doubling in value because it's just growing, and you're buying into Facebook in 2005, dividends don't matter because you don't want dividends. You want the company to reinvest. The idea is there that a company reinvesting when they can keep growing is better, because in the future, the dividend payout will be much higher. The problem is there's a risk, because what if the company never grows? Like they stop growing, they shrink, something like that happens. The benefit of the risk of getting dividends today is, what if the company needs that money tomorrow? You got a big dividend payout at the beginning of this year, and now the company is close to bankruptcy because, you're a cruise line and nobody's going on cruises. You probably, in that case, wish the company had kept some of the dividend so that they would have had cash to fall back on, so they didn't go under. You have an all equity firm, 100 shares, 10% return. Your expected cash flow is $10,000, and you're planning to dissolve the firm in 2 years. Now, this is something where you have a company that's created to do something specific. You might have, like the Tokyo Olympics. There are companies that were created purely to do something connected to the Tokyo Olympics. It is planned to dissolve after a certain period of time, because that's when that, whatever it was created for, goes away. So if you need to make 10%, you can either pay out dividends every year, or you can pay it out in 2 years. So either you pay it out over time, every year you just pay out a little bit until the end, or you wait until the end and pay it. when you have that with the cash flow, you have your cash flows, you have your all that, your stock price would be the same in both cases, um, but your you know diluted earn per share is going to be different. With your first one, your shareholders, they're going to get more money the first year, less the second, whereas um, the new shareholders get more money that second year than the original shareholders. Um, when you might have some people who want a lower dividend. Some people will argue for a lower dividend because debt might be when you have certain bonds, it might say, oh, you're not allowed to pay out dividends of more than this percentage. That's to keep a company from getting a lot of debt and using that debt to pay out dividends and then going bankrupt. You might have uh, people who don't want to pay out dividends because you're going to have to borrow money in the future to pay for that dividend to make up for that because you're doing an investment. So they'd rather no dividend and then save that money from the borrowing. And then you might have people who are in a high tax bracket who don't want dividends because they don't need the money today. If you get a dividend today, you have to pay taxes on it. If the company keeps the dividend and your stock price goes up because of it, you don't have to pay taxes. On the other hand, you'll have people who are in low tax brackets who want the dividends now because that spreads out their earnings. If you make 10% per year in dividends and you are in a low tax bracket, it's a lot better for you than to make no money for 10 years and then get all that earnings all at once, because that can actually push you into a higher tax bracket, even though that money has to last you for 10 years. Also, there are groups like endowments, trusts, those kinds of things where you can't spend or can't sell the principal. So somebody donated 50,000 shares of Microsoft stock, and the endowment cannot sell that Microsoft stock. They're stuck with it. Dividends in that case is the only way they make money. So they want high dividends because they can actually make money. They don't care what the share price is. The other one is you can have people who want the dividends now because they don't know if they don't trust that in the future they will be available. Give me the money today because a dollar in the hand is worth two in the bank. That kind of idea. You got money in the future maybe, or money today. Well, give me the money today. Your taxes, there are some tax advantages to paying dividends. And if you're a company or not a company, you're a charity and you own stock and that's part of how you fund your operations, you don't care about capital gains and all that because you don't pay taxes anyway. So for you, a high dividend is better than low. When you have stocks that are famous for paying out high dividends, they will attract investors who want high dividends. And if you have stocks that are famous for paying out low dividends, they will attract investors who prefer low dividends. This can allow a company to tailor the kind of investor they want. Investors who are going to buy the stock and hold it for a long period of time tend to be higher payout customers. Customers that are going to buy and sell the stock pretty quickly tend to be the lower. Obviously, there's a lot of variability in this, and it does not mean every low dividend investor is a short-term investor or every high dividend investor is a long-term one. But just generally speaking, that's how it works. This means if a company wants to be, their stock price to be swinging wildly up and down, because that makes them exciting, that gets more investors, that gets them on the cable news, all that kind of stuff, they might go with a lower dividend payout in an effort to spur that on. If a company says, no, we want to be a bedrock company that people think of as reliable, all this kind of stuff, they might go with a higher dividend payout as the idea that, we're stable, this money is coming in every year for the net, trust it for your retirement. So that is the difference in these people, in the type of investors you get. So if a firm changes which one they're using, they go from a high dividend to a low dividend, or a low dividend to a high dividend, that changes the kind of investor that wants the stock, and can either boost the stock price a lot or drop it like a rock. Now, some companies will buy back shares of their own stock. They can either there's a couple ways they can do this. One, they can go and just buy them on the open market like any other customer. They call their broker and say, buy up 20 shares of this, and it's their own stock. They can set up and say, hey, we're buying back stock at $10 a share, and we want 10,000 shares. And then they just leave it there and ask people, say, yeah, $10 a share, that's what I want to get for this stock. They can come and they can buy it. This is mainly done if your share price is going down. The company can set a floor on the price and say, we'll buy the shares back at this price. That means that nobody's going to sell the shares for less than that. If the company is willing to buy them for $10 a share, you're not selling the stock for $9. If somebody offers you $9, you'll say no and take it to the company and buy it and sell it to them for 10. The other one is targeted, where they go after, there's a company that has invested in this other company, and that other company doesn't like it. So they go up to them and they say, we will buy all of your shares for X amount extra, so you get a return, just so you stop messing with our company. This is often done for activist investors. You have somebody who's, you'll see people who are wealthy, who care about certain causes. They'll buy up a bunch of stock in a company and try to get the company to change its policies. Say somebody wants the company to be more environmentally friendly. The other investors might say, we don't want to be environmentally friendly. That isn't making us as much money. So they'll basically get the company to buy that in activist investors' stake in the company away from them, just to get rid of them. The difference between a repurchase versus cash dividend, the main thing here is you don't get any cash if you're not part of the buyback. If you don't sell your shares to the company, you get no cash. However, because there are fewer shares on the market, the price goes up. So you get more value, but you don't get cash. On the other hand, if you have a dividend, your shares go down in price, but you do get cash. Which one is preferable? That is a question for a lot. You have to know exactly what your different investors want, and it is all individual. Repurchases became very popular. Anytime the market crashes and interest is cheap, repurchases become major, because companies can borrow money for the future at low prices and buy up stock really cheap. That allows them to boost how much money they pay, or how much they can buy up. If your stock drops in half and you have $10 million to buy stock, you can buy back twice as much stock. With cash dividends, you can't control how much money you get. It just comes whenever the company sends you the check. With it's not necessarily taxed as ordinary income, because dividends are a special case. Just no, tax law is complicated. Repurchases allow a company or a person to decide how much they want to take cash. So if I need $10,000 in cash for something, I could, with a repurchase, sell $10,000 in stock and get my cash. Dividends, I can't control when that money comes in. I might get $10,000 today. I might not get anything. It's also only taxed if they sell. So if they don't sell the stock, then it's not taxed. It just sits there. The summary, it is, there's a trade-off between dividends and buybacks. It's heavily dividends are heavily factored in by the investors and the kind of investors the company wants and all those kinds of things. You generally don't see big changes in dividend structure. Dividends that pay out, a certain amount every time. That's why people like it. They don't want big changes, and the stock will change drastically if you do change how much your dividends are. So if you've been paying out $5 share dividends every year for the last 10 years, and you suddenly change it to $2, your shares will plummet because unless you can come up with a good reason why. More just basic dividends, pros and cons. We kind of already went on with over these. Stock dividends, in my opinion, are stupid. It is, you're giving people shares rather than cash. So you have 10 shares, and I say, here's an extra share. The problem is all of your shares are now worth, if your shares are worth $1 before, you had $10 worth of stock. I give you an extra share of stock, you have $10 worth of stock. It doesn't actually, there's no real value. The only thing that it can do is, if you're trying to maintain a certain price point for your shares, say $50, and your shares have been going up in price and they're now sitting at 60, if you give a sixth of a share for every 5, or a fifth of a share for every share people own, you can lower your price back down to $50. Stock splits are basically a stock dividend, except there's really good reason to do stock splits. If your stock gets too expensive, it's now $10,000 a share. Very few people can buy one share. It's not easy for people to buy shares and buy an exact amount. I want 25% of my investment to be in this company. Can't, because you either have 30% or 20%, because that's how much the stock share price is. So if you split, you can lower the price of the shares down to a more reasonable level. You can also, if the stock company goes through a really bad time, you were worth $100 a share, now you're worth $1 a share. You can do a reverse stock split where you put all that money back, you put those shares together, you take back everybody's 100 shares, and you give them one share in exchange. That one share is now worth 100 times which each individual share was. That allows a company that was trading low to come back up and avoid being delisted. Companies with a stock price that's too low generally are considered bad investments just because the price is so low. If you have a stock that's trading for 2 pennies a share, most people won't touch it with a 9-foot pole. If you have a company that's trading for $20 a share, same exact company, but just with 1,000 less, percent less stock, people will say, "Oh yeah, I'll take that company seriously." Does anybody have any questions about dividends?
No,
No.
I don't think so.
Okay. So, fun stuff.
Always.
Okay. Does anybody have any questions about anything we covered today? Your paper, what to do about getting a letter grade or pass fail grade, or any other subjects pertaining to this class?
No questions.
You mean is the paper that you're talking about our project?
Yes.
Okay.
Do you have a question about it or no?
No, I just wanted to make sure it was the same thing
Oh.
and not something separate.
All right. Well,